learners, topic of the today's lesson is types of business entities and types of securities. There are different types of business entities, that means business organizations, in the form of which we can do a business. So, we shall learn about basically three types of business entities, although there are many more, but prominently these three are in practice, that is sole enterprises, partnership firm and limited liability company, which is also called as joint stock company. These three are more prominent. However, we have one person private limited company also, or we have Hindu undivided family business structure also. So, I will focus on these three only, as these three are more prominent. Once we learn about these three entities, then we will focus on from where the funds are secured, what are the different types of securities through which a company can finance its operations. Sole enterprises. A sole enterprise is owned by one person called as owner of the company. Single owner contributes the capital. As you might be knowing, capital means requirement of funds to run the operations of the company, that is investment in fixed assets and current assets. So, only single owner contributes the capital, and that single owner or sole owner will bear the risk. When we say risk, risk means probability of a loss or chances of getting less returns as compared to the estimated returns. So, only this single owner will bear the risk. It means when one person is bearing the risk, and in sole enterprises we have something called as unlimited liability of the owner. When we say unlimited liability of the owner, it means that if business assets are not sufficient to repay the business liabilities, then personal property of the owner can be used to fulfill those liabilities, to fulfill those losses of the business organization. Let me give a recap to you what an asset is. An asset means all the resources which are owned by the organization or controlled by the organization. More appropriately, it is owned by the organization under the ownership of the organization. Whereas liability means whatever is owed by the organization to others. It may be owner, it may be money lender or financier. That means we have two basic aspects, assets and liabilities. So, under sole enterprises, liabilities of the owner are unlimited. And then when we have to start an organization or a business in the form of sole entrepreneur or as a sole entrepreneur, we need not to go for any kind of a specific documentation. We can start without much larger formalities or much larger documentation. Then comes partnership. When we were doing business as sole entrepreneur, our contribution capacity or capital capacity is limited and risk is unlimited. There comes the role of partnership. Partnership results from an agreement between two people who agree to do some business activity for profit sharing. So, there we say partnership is the result of an agreement between partners. The agreement is about doing business activities, and under partnership the business organization is called the firm. So, partners are individually called as partners, and organization in the form of which they are doing the business, that is called as firm. Firm is managed by all the partners as per the provisions of partnership deed or partnership agreement. Let me remind you, partnership agreement is must, and more preferably it should be written and registered, so that interest of each partner gets protected. Now, what are the features of partnership? That means an organization which is financed and run by two or more owners, that is two or more owners are there. As per law, Partnership Act, which is governing the partnership firms, maximum 10 or 20 partners can be there. If an organization is doing banking business, if a firm is doing banking business, maximum number of partners in a partnership firm can be 10, whereas if a firm is doing other business, that means other than the banking business, maximum number of partners can be 20. Then comes the agency relationship. It means when one partner is executing some deal or some deed, he is representing the other partners ipso facto. That means to say one partner is the agent and the owner of the organization, or one partner is agent of other partner. In partnership also we have unlimited liability. That means at any point of time unluckily or unfortunately assets of the partnership firm are not sufficient to repay the liabilities of the partnership business, then definitely personal property of the owners can be used to fulfill the losses. Now, capital contribution is not necessary. It means in a partnership organization, one person or two person might contribute the capital and rest of the partners might contribute their skills. So, under partnership organization, capital contribution is not must. Only thing is that one has to be the part of the agreement for partnership. Partnership is governed by the Partnership Act in India, and for the better interest of the organization or for the better interest of the partners, it should be registered. Then comes the third form of business organization, limited liability company. Limited liability company is an association of large number of contributors, large number of people who contribute the capital for the business purpose. The capital contribution by the contributors or the shareholders is in the form of shares, hence they are called as shareholders. So, a share is the smallest unit in which we can make an investment in the company or through which capital of the company is distributed. If we assume that a company is started with a capital of 100 crore rupees, so it might have 10 crore equity shares of rupees 10 each. So, there we say shareholders who are contributing the capital, they can buy the shares of the company and contribute the capital. So, capital contribution in a limited liability company is in the form of shares. By purchasing the shares, one can become the shareholders. When we say limited liability, the liability of the shareholders is limited up to the value of shares purchased by them. If an investor has invested 10,000 rupees in a company, his liability is only up to 10,000. If a company incurs more losses or at the end of the business activity, at the end of the year or when business is culminated, there are heavy losses in the business organization, heavy losses in the company. The shareholders cannot be asked to contribute towards the losses because liability of the shareholder is limited up to the value of shares purchased by them which they have already contributed. So, there comes the difference between sole enterprises and partnership and the limited liability company. Under sole enterprises and partnership, liability of the owner was unlimited, whereas in case of a company, liability of the shareholders who are the owners is limited up to the value of shares purchased by them and they have already paid that money. So, they are not required to contribute any more in the losses of the company. Now, what are the features of the limited liability company? It is a legal separate entity, limited liability of the owner or shareholders, separation of ownership and management, capital represented by shares, risk sharing by large number of shareholders. Shareholders have residual claim and can be closed through legal procedure. It means a company comes into the existence through legal procedure. It can be winded up or closed down only through legal procedure. Although these things can be discussed at a length in accounting course, so that was the only orientation is required in financial management. Reason being, we will be talking more about different types of securities that is more appropriate, that is more required under the financial management and not the forms of business organization. So, this is the brief orientation about the different types of business organizations through which an entrepreneur can start his business, either sole entrepreneur or partnership or a limited liability company. Then when we talk about limited liability companies, in any country it can be either in the form of a public limited company, private limited company, government company, holding company or subsidiary company or chartered company. I will talk more about the public limited company and private limited company. Limited word is confined that okay, responsibility or liability of the shareholders will be limited up to the value of shares purchased by them. They are not required to contribute in the losses of the organization if organization or company goes into losses. Then what is this public limited and private limited? So, many people get confused when we say public limited company, they think it is government company, but my dear learners need not to think about that, think like that. Public limited company means a company which can invite general public to contribute towards its capital through an advertisement, and you might be seeing that there are many IPOs, initial public offering. So, a public limited company is the one which is authorized to come out with IPO or FPO. IPO means initial public offering and FPO means follow on or further public offering. Whenever a public limited company issues its shares first time in the market, that is called as IPO. Anyone who is interested to make investment in the company, he can read the prospectus of the company, profile of the company and apply for the IPO. And if he is successful, then definitely he will be allotted the shares, and as soon as he is allotted the shares, he becomes the shareholder and he is the owner. That means to say, if there are 1 crore people in a company who have contributed the capital, all the 1 crore people are the shareholders, all the 1 crore people are the owner of the company exactly in the proportion of money contributed by them. So, a public limited company is started by minimum 7 promoters and it is authorized to come out with the public offerings either in the form of IPO or FPO. Whereas a private limited company is the one which can be started by 2 owners and it cannot invite general public to contribute the capital towards its organization through mass media. It can go door to door, it can go personally to different individuals, financial institutions or banks to contribute the capital, but it cannot invite general public through mass media. So, that is the difference between public limited company and private limited company. Now, other difference is that a public limited company, as soon as it issues the shares to general public either through IPO or FPO, its shares must get listed on a recognized stock exchange. In India, there were earlier many stock exchanges, but now only 2 prominent stock exchanges are there. Bombay Stock Exchange, called as Mumbai Stock Exchange, or National Stock Exchange is the second one. It means as soon as a company comes out with IPO or FPO in the market, its shares must get listed on any of these 2 exchanges or on both the exchanges, depending upon the declaration by the company. That means to say, once these shares are listed, these can be bought and sold on the platform of the stock exchange or through the brokers of the stock exchange. So, that is where the definition comes, a public limited company shares can be listed on the stock exchange. And let me remind you, all the listed companies on a stock exchange are public limited company, because private limited company cannot get listed on the stock exchange. Now, here comes the second part of the lecture, that is capital of a firm, or from where a company or a firm will arrange the capital. Capital of a firm, that means requirement of money invested in the fixed assets and current assets, can come from 2 major sources, or sources of capital can be classified into 2 parts, owner's equity and borrowed capital or loan. By owner's equity means the amount of money contributed by the owner. How much money owner has contributed either in the form of shares or in the form of retained earning is called as owner's equity. If it is sole enterprises or partnership, the amount of capital contributed by the owners or the partners is called as owner's capital or owner's equity. Whereas, if a company goes to a bank or a financial institutions and borrowed the money, then that money is called as borrowed capital or loan capital. So, broadly there are 2 kind of capitals, owner's capital and loan capital. Owner's equity. In a company, more aptly in a limited liability company, it comprises of equity share capital, preference share capital. Now, what is an equity share? Equity shares means the shares which represent the real ownership of the company. Those who are the shareholders of the equity shares, they are called the real owners. When we say real owners, it means they are the ultimate owner of the company. They bear the risk of losing their capital if company becomes unsuccessful, but at the same time greener side of the equity is that they will be getting unlimited quantum of profit. That means they can get the huge amount of dividend, they can get the bonus shares also as and when declared by the company, and they are owner of the company exactly in the proportion of shares held by them. When I say owner, now what is the role of that particular owner? All the major decisions in a company are taken in the meeting of the shareholders. That means to say, it is necessary for a company to hold the meeting of shareholders every year at the end of the financial year, invite all the shareholders who will cast their vote according to their proportion of the shareholding, and major decision like merger, acquisition, inviting new capital, launching new scenario, entering into the new market, and all that will be done through those decisions. So that means equity shareholders are at the helm of the affairs in a company, they are the real owner of the company. But the darker side of the equity shares is that they contribute towards the losses also. That means to say, if company is winded up, they will be the last one to get their return of the capital, ensuring that all the other people are paid. Then only if something is left out of the assets of the company, they will be getting their share in the company. It means equity shareholders are the claimant for the residual. Residual means jo kuch bach gaya, whatever is left over. So that is where the equity shares are there. On equity shares, company never promises any kind of fixed dividend. Dividend is decided as and when declared by the company, declared by the board of directors of the company. Board of directors of the company are the managers who are appointed by the equity shareholders. Board of directors will discharge day-to-day activities depending upon their area of activities. They will talk about the managerial decision, strategic decision. They will guide the managerial team, and at the end of the year, board of directors will brief the shareholders who are the owner of the company what was done throughout the year, what profit has been earned, and what is the future plan. So that is where board of directors are responsible or answerable to owners of the company, that is equity shareholders. Another aspect of the equity shares is that equity shares are non-redeemable. That means to say, once equity shares are issued by the company, they have no maturity period. The shareholders can get back their money only on two occasions. Number one occasion, if a buyback offer comes, or number last occasion, if company is closed down and they can get back their money. Then you might be surprised, why should I invest in the equity shares? Because once I pay the money to the company, there is a least probability that I will get back the money. But learners need not to worry about that. There is a one way out. As soon as a company issues equity shares through IPO or FPO, these get listed on the stock exchange. The shareholders can sell their shares in the market through the intermediaries of the stock exchange and get back their money. It means there is a gateway. By selling the shares in the market, one can get back his money. Equity shares are transferable. The next chunk of the capital comes from the preference share capital. Preference shares are the one on which company promises a definite percentage of profit sharing, that is dividend, depending upon the quantum of profit or availability of profit. That means as soon as a company has sufficient profits, a fixed percentage of dividend will be given on the preference shares. Preference shares are generally having a maturity period. That means at the end of the maturity period, money of the preference shareholders will be returned back to them. But preference shareholders are not the one who can cast their vote in the board of directors meeting, or who can cast their vote in the shareholders meeting. It means preference shareholders get the fixed dividend, they have the definite maturity, but they are not the real owner of the company, in the sense they cannot cast their vote in the meeting of the shareholders to decide about the fate of the company. Preference shares can be of different types. These may be redeemable versus not redeemable. Redeemable means a kind of preference share which has got a fixed maturity, at the end of which money, that is capital or contributed money, is returned back to the shareholder. Whereas non-redeemable shares are the one which are not having any kind of maturity. The money is not returned to the company during the lifetime of the company. Money will be returned only if company is closed down. As of today, non-redeemable preference shares are not issued in India. After 1971, none of the company can issue non-redeemable preference shares. Only redeemable or convertible preference shares can be issued. So that was redeemable shares, preference shares, and non-redeemable. Another category of preference shares is convertible versus non-convertible. Convertible preference shares are the one which can be converted into the equity shares of the company at a future time. So when company issued the preference shares, at that time only company will specify that is there a provision for conversion of these preference shares into equity shares of the company at a future date. If yes, then given the conditions of the conversion, these preference shares will get converted into equity shares of the same company. It means, let us take an example, a company issues rupees 100 face value convertible preference shares to be converted into 5 equity shares of face value 10 each after 3 years. That means for first 3 years these will remain preference shares, and if company had assured 12% dividend on the preference shares, so depending upon the earning of the profit, company will give dividend for first 3 years at the rate of 12% per year. At the end of third year, preference shareholders need to surrender their preference shares, and in exchange of each preference share they will get back 5 equity shares of the company. That means they will become equity shareholders of the company. So that is the provision of convertible preference shares. Another category may be non-convertible. It means the preference shares which are not having provision of conversion into equity shares of the company are called as non-convertible. So we have second category learnt about convertible versus non-convertible. Then the third category is participating preference shares. As you might be remembering, few minutes ago I said on preference shares company assures a fixed percentage of dividends subject to the availability of profit. So payment of dividend on preference shares is conditional. As soon as there is a sufficient profit with the company, then only dividend will be paid on preference shares. But companies came out with the innovation, they made something called as participating preference shares. That means to say such kind of preference shares in which company might pay higher amount of dividend over and above the assured percentage only when company has supernormal profits or good amount of profit. So those conditions are specified at the time of issue of the preference shares, and according to that preference shareholders can participate in the extra profit or supernormal profit of the organization. So these are the three prominent categories of preference shares: redeemable versus non-redeemable, convertible versus non-convertible, and participating preference shares. Let me remind you once again, as of today, none of the company in India can issue non-redeemable preference shares. Then third kind of capital from the owner comes retained earning. Retained earning means that quantum of profit which is not distributed as dividend among the shareholders, instead it is reinvested in the organization. It is withheld in the organization for the purpose of reinvestment. So that also becomes the part of owner's equity. So in general, when we talk about owner's equity, it includes equity share capital, which is the real ownership of the company, preference share capital having restricted ownership of the company, and the retained earning. Let me remind you, retained earning is separately not traded in the equity market or stock market. Only equity shares are traded in the stock market. Those who are the equity shareholders, they are also the claimant of the retained earning. That means to say, as soon as company has huge amount of retained earning, there is a possibility that that retained earning might be converted into paid up capital of the company by issuing the bonus shares. So charm with the equity shares is that equity shareholders have the probability of getting bonus shares also. Now what is bonus share? A bonus share is the one which is issued free of cost to the existing equity shareholders of the company. So let us take an example. A company was started with 100 crore rupees of equity share capital and 50 crore rupees of preference share capital. Year on year company kept on earning the profits, gave the dividend to both the kind of shareholders also, and after 10 years, if you look at the reserves and surplus of the company, that means retained earning of the company, we see that company has got 500 crore rupees of the retained earning. Now practically this 500 crore rupees belongs to equity shareholders. So they contributed 100 crore initially, this 500 crore also belongs to them. Preference shareholders contributed only 50 crore, they are claimant only for the 50 crore. Now at this juncture, if company thinks that they have got sufficient quantum of retained earning, which is already invested in the expansion program of the company, now company might decide to give bonus shares. So let us say company decides 1:1 bonus share. It means everyone who is having one equity share, he will get one more equity share free of cost from the company. It means if a shareholder is having 100 shares at that point of time, he will get 100 more shares without paying anything to the company. Now paid up capital of the company will become 200 crore and retained earning will get reduced to 400 crore. Earlier it was 100 crore equity and 500 crore retained earnings. Now out of the retained earning, 100 crore has been converted into paid up capital by issuing the bonus shares. So in that way equity shareholders get benefited. As soon as a company announces the bonus shares, share price will increase and equity shareholders will get benefited. That is called as achieving the wealth maximization objective of the financial management. So retained earning can be used in that way. So it can be used in two ways. It is getting reinvested in the form of cash reinvestment, but it can be used to give bonus shares without harming the operations of the company, without affecting the liquidity of the company. So that's where equity shareholders have the benefit of bonus shares also, and that is why as soon as company declares the bonus issue, share prices of the company start increasing. Then second chunk of the capital comes from borrowed capital. As the word says, borrowed capital, that means company has borrowed the money from different angles, different sources, different avenues. There are two prominent avenues. One is that either go to the financial institutions or banks, make an application for the loan and take the loan. Another avenue is go to the capital market, issue the securities, that is debentures, and arrange for the loan. So let me define what a debenture is. A debenture is a kind of loan taken by the company from general public. It means if a company is not interested to issue equity shares or preference shares, it can come out with an advertisement in the newspaper. So if it is a public limited company, definitely it can come out with an advertisement in the newspaper inviting general public to buy the debentures of the company. Those who are interested to make the investment, they will make the investment in the form of giving a loan to the company. So as soon as a person buys the debentures of a company, he is like a money lender to the company. He is giving a loan to the company. On each debenture, company has a legal and contractual obligation to pay the interest. So let us assume if a company issues 100 rupees face value debenture carrying 15% rate of interest, that means to say company is bound to pay 15% interest every year on the face value of the debenture. By face value of the debenture, we mean the value at which it is recorded as a liability in the books of accounts. So every year company will pay rupees 15 on rupees 100 debenture so long as debenture remains in existence. So debentures generally have a fixed tenure, that is fixed maturity period, 5 years, 7 years, 10 years, 2 years, these are the some of the examples, but company is free to decide what should be the maturity period depending upon their requirement. So debenture is a kind of loan taken by the company from general public. On debenture, interest payment is legal and contractual obligation of the company. Debentures do have a fixed maturity period at the end of which debenture holders get back their money. And another thing with the debentures is that debenture holders have a prior claim over the preference shareholders and equity shareholders. It means if company goes into liquidation, company has paid all the government dues, dues of the employees and suppliers, and now assets are to be sold out and three claimants are left out: debenture holders, that is money lenders, then preference shareholders and equity shareholders. So by selling the assets, first of all claim of the debenture holders will be met, then it will be the turn of preference shareholders, then it will be the turn of equity shareholders. So equity shareholders are the claimant on the last line, or they are the residual claimant or claimant for the residue, whereas debenture holders will rank first, then preference shareholders, and then the lastly equity shareholders. So in that way debenture is a kind of loan. Now when a company issues the debentures or arranges the borrowed capital by going to the capital market, then debentures can be of different types: redeemable versus non-redeemable debentures. Redeemable debentures are the one which have a fixed maturity period at the end of which debenture holders get back their money, whereas non-redeemable debentures are the one which don't have any maturity. These are called as perpetual debentures. It means these will continue till the lifelong of the company. The day company is closed down, then only their money will be refunded or repayment will be done. So practically, as of today, non-redeemable debentures are again not in practice, only redeemable debentures are in practice. Company will specify the redemption period 5 years, 7 years and something like that. So every year company will pay the interest. Interest calculation is done on the face value or paid up value of the debentures. So every year company will pay the interest whether company earns the profit or not, and at the end of the maturity company will pay back the money. So there comes the difference between interest and dividend. Interest payment is legal and contractual obligation for the company, whereas payment of dividend is not contractual, not legal, because dividend payment is distribution of the profit. That means if company has the profit, only then dividend can be paid or question of dividend payment arises. Whereas whether company earns the profit or not, payment of interest on debenture or payment of interest on loan is must for the company. Otherwise, debenture holders or the money lenders can go to the court, get their claim through the court also. So first category of debentures is redeemable versus non-redeemable. Second category is convertible versus non-convertible. So as name suggests, convertible debentures are the one which have a provision for conversion into equity shares of the company depending upon the provisions of the conversion. Now whether a debenture will get converted into equity shares of the company or not, all the terms and conditions are specified by the company at the time of inviting the application for debenture. Each debenture will get converted into how many debentures, at what point of time, everything will be specified in the beginning. At later point of time it cannot be changed, it cannot be altered. So convertible debentures are the one which have a provision for conversion into equity shares of the company at a later date, that is on the date of conversion. Whereas non-convertible debentures are the one which do not have the provision of conversion into equity shares of the company. However, in both the cases, convertible debenture and non-convertible debenture, interest payment is must for the company whether company earns the profit or not. So initially when companies were started in the old time, we used to have only two kind of categories: redeemable versus non-redeemable, convertible versus non-convertible. With the invention, with the requirement, with the modernization and advancement, many more categories came. So one more category came somewhere way back in 1995, debentures with warrants. Now what is a warrant? A warrant is sweetener attached to the debenture. Now when a company issues a debenture with warrant, that means to say a company is issuing the debenture and along with that a coupon is associated or attached. This coupon, called as warrant, can be exchanged against the equity shares of the company by making a definite payment. So if we assume that a company issues a debenture of rupees 100 each, redeemable after 5 years, on which company will pay 10% interest year on year, and each debenture is accompanied with a warrant, and on this warrant is written that this warrant can be exchanged for the equity shares of the company after 2 years by making a payment of rupees 25 per share for every 10 rupees face value equity share. Now it means to say debenture will continue for 5 years because its maturity period is 5 years. On the debenture, company will pay interest year on year for 5 years. Now warrant is additional coupon given to the debenture holder. He can exercise his option of converting that warrant into equity shares of the company exactly after 2 years, which is mentioned in the warrant. After 2 years, if a debenture holder who is holding the warrant also, he can go to the company, exchange this warrant against the equity shares of the company. He has to pay 25 rupees per share for a face value rupees 10 share. Now at that point of time, that means at the end of 2 years, if market price of the equity shares of the company is more than 25, then definitely this debenture holder who is having the warrant gets benefited by converting his warrant into equity shares. Otherwise, he will not convert it and that warrant will lapse. So that is the provision. So it is a marketing tool to sell the debentures in the market. So a warrant is sweetener attached to the debentures. So that category of debenture is called as debenture with warrant. Then the next category came debenture with option, that also came in somewhere 1995. Now option means giving an alternative. Now sometimes company might give a debenture to the debenture holders with option to either convert it or continue as debenture holders. So they are called as optionally convertible debentures, optionally redeemable debentures. So if a company has issued debenture with option, it means, let us say original maturity of the debenture is 25 years, at the end of which company will pay back the principal amount, that is the face value. However, in between company might embed the option only at the time of issue, that yes, debenture holders have an option to get their money back at the successive interval of 5 years, 10 years, 10 years and 15 years and 20 years. It means to say, although 25 years is a long period, initially an investor purchases the debenture with the maturity of 25 years. However, he is given a gateway. At the end of 5 years, if he needs back his money, he can go to the company and claim back his money according to the provisions of redemption. If not, then he has again a chance to go at 10 years, 15 years or 20 years. So that kind of option is provided in the debenture. Option can be of two types, call option and put option. If a debenture is having both the type of options, call option and put option. Call option means if company wants, they can also go for the premature redemption of the debenture according to the provisions of the issue of the debenture. And put option means if a debenture holder wants, he can exercise his option, surrender the debenture and claim his money from the company according to the provisions of debentures. So debentures with option can be with call option or put option. Then the another category is deep discount debenture or zero coupon bond. As the name suggests, zero coupon bond. Coupon is technically called as interest. So in the debenture market, interest is also called as coupon. So that's why few people say interest rate is equal to coupon rate. Now zero coupon means such kind of debentures on which there is no interest payment provision. That means to say throughout the life of the debenture, company will not pay the interest. Then you might be surprised how the debenture holder will get compensated. Why should one buy zero coupon debentures? Let me tell you, zero coupon bonds or deep discount debentures are the one which are issued at a heavy discount to face value and redeemed at par on maturity. If we take an example, let us say rupees 2000 deep discount debenture issued by a company at 60% discount and to be redeemed after 5 years at par. That means to say at the time of purchasing the debenture holder will be given the 2000 rupees debenture only at 800 rupees because 60% discount means 1200 rupees discount. He will pay 800 today. After 5 years, he will get back 2000. So the gap between 2000 and 800, that is 1200, is like accumulated compensation for interest of 5 years. So that is how deep discount debentures work in the market. So these are issued at a heavy discount to face value and have a provision for redemption at par on the maturity. That's why these are all called as deep discount debenture. And zero coupon debenture also they are called as because there is no provision for interest payment year on year. Then with the passage of time, innovation came floating rate debenture. As initially I told you, debentures have a provision for interest at a fixed rate of interest. If a company issues debentures say with 9% rate of interest, so year on year company will keep on paying 9% interest. However, companies came out with the innovations, they came out with floating rate debentures. It means a debenture in which company assures a minimum floor rate, that is minimum rate of interest, and there is a provision for upward revision depending upon the changes in the market scenario. So let us say if a company issues floating rate debenture with floor rate 9%, floor rate means minimum rate, and there is a provision that if in the market general rate of interest either declared by RBI or in the capital market by any other company, then company gives it a provision that with the increase in interest rate by RBI by so much percentage, additional interest will be paid on these floating rate debentures. So that kind of debenture is called as floating rate debenture. So if RBI rate goes up, there is a provision for payment of extra interest on these debentures beyond the 9%. But in none of the cases it will fall below the floor rate, that is 9%, which is assured by the company. At this point of time, 9% is only an example. Floor rate is decided by the company depending upon its capacity or analysis. Then lastly, we have indexed linked debentures, a new innovation in the field of debenture. As you might be knowing, stock market index, whether it is index of Sensex, that is Mumbai Stock Exchange Sensex, or Nifty, they keep on going up and down. So sometimes debenture holders have a charm that why shouldn't they get the benefit of increase in the index. So companies came out with the innovations. They started issuing debentures with index linked. It means to say, in these debentures there will be a provision for payment of interest at the minimum rate called as floor rate, which will have a provision for upward revision. Like if suppose index goes up by 100 points, there will be a provision for 0.5% additional interest payment, further 100 points, then again additional 0.5% and so on. It means they will get the benefit as soon as index keeps on increasing. But in none of the cases interest payment will fall below the floor rate that is promised by the company, and decision of floor rate is by the company. None of the legal authorities or government authorities can intervene in that. So these are some of the kind of debentures we have talked about. Then borrowed capital can come for the company by taking a long term loan or short term loan also. By loan means company is going to a particular financial institution or a bank to arrange for a loan. Company makes an application, bank will evaluate the application and evaluate the proposal of the company. Depending upon feasibility of the proposal, bank will give a loan. On a loan also, company is required to pay interest every year whether company earns the profit or not. Loan can be secured or unsecured. That means secured loan is the one which is secured against the asset of the company or particular asset of the company, or unsecured means which is not secured against the particular asset of the company, or it is secured in general. Similarly, debentures can be secured versus non-secured. If a secured debenture is there, that debenture is secured against a particular asset of the company, and if a non-secured debenture is there, it is secured against the general assets of the company. So these were the things which we have discussed in this lecture, different forms of business organization and how particularly a limited liability company can arrange funds either from owners or from borrowed capital. That was the brief of this particular one. Thank you.